Alright, YouTube, Stocks by the Numbers, welcome back. Wanted to take a look at a company that a lot of you may use their service, and I just wanted to take a look at the stock here to see what's going on, and in my opinion, we got a little BS happening here. Name of the company we're looking at is Spotify Technologies, ticker symbol SPOT, listed here on the New York Stock Exchange. Now, the stock is up to a little over $158 here. 12 cents, up over 4.5 points today, about a 3% move here. And in my opinion, this is just ridiculous. So first of all, I marked these two levels here. As we can see, we had our gap up here. This was a little after the bull drop, the end of January. And you can see we gapped up, we bounced around, and I basically just marked out these two key levels here. This was the last time I looked at the stock. And I may have even mentioned it in the Discord back in August. And as you can see, we had a pullback here going from around the 150 level down to sub 130 after the company missed earnings, of course, as they do. And for some reason, we bounced off this BS imaginary level here that someone thinks was relevant. And then we rallied all the way back up to this fib here of about $168 before bouncing around, and we're still sitting at 158. And this is why I laugh, right? Because when companies who post dismal fundamentals get rewarded, I kind of get thrown for a loop, and I have to make sure that my head is screwed on properly, and I might have to take like a cognitive test or something like that to make sure all my pistons are firing up there, because in my opinion, this stock should be down drastically. And for some reason, they brought it back up again, the retracement on the fib, and basically just kind of flattened it out for the last several weeks. And for the life of me, I really cannot understand why. So right now we're talking about a $30 billion company, okay? They sell music, I believe, right? That's what this company does? Digital music service, okay? So you subscribe to them and pay them, and they let you listen to music. But somehow that is drastically unprofitable. As we see here, the company is losing almost $5.25 per share, right? And mind you, they've been around for all these years. This is what makes me laugh about these companies, right? Look at the dismal graphic here on the EPS. Missing by 16%, 9.4%, 34.5%, and then, of course, just completely falling off a cliff. But yet somehow the stock went down and went higher than where it was before they posted those numbers. Please have it make sense. Now, of course, people can throw back in my face, oh, well, look, the revenue has been consistently increasing. Hey, listen, good point. What you're not seeing, though, is that apparently the more money they make, the more money they lose. As you see, the profit margin, negative 4% off $3 billion. And consistently dropping down now 9.5% as of Q2 of 23. Now, a lot of people may say, oh, well, let's look at the numbers. I'm sure, they beat on revenue here to start this big rally. Really? Really? Let's check it out. A miss on the top and bottom line, stock went higher. Actually gapped up for some reason. A miss on the top and bottom line, stock went higher. And then we come out here, a miss on the top and bottom line. Stock finally went lower, and then immediately went back to where it was and has flattened out. So this is why, again, this may be supposedly a little bit more of a risky play because, of course, as we see, the numbers are not adding up to what the stock is performing here. So in my opinion, it will inevitably drop down and go lower. The question is, when is it going to happen? And, of course, I am not Nostradamus. I cannot tell you exactly when this is going to happen. The one thing I will say is that this level of 119.60, I mean, that's a dunk shot. That should be there now, and we should potentially be talking about filling this gap back down here to about 104. Next quarter earnings coming out Tuesday, October 24, expecting $3.51 billion, and of course losing 23.5 cents because, when you make $3.5 billion, you got to buy shit, right? And you got to spend it on stuff. So, you can't bring in $3-4 billion and make money. Are you out of your mind? You know who you're talking to? And we look here, and we can see phenomenal growth. Look at this, man. I mean, I can't deny the revenue. going up to north of 7.5 billion. Look at this, 9 billion, 11.4, 12.3. That is insane growth, right? 5 years ago, they were at 6. Now they're north of 12. They have doubled revenue in the last 5 years, yet somehow still losing money. Always makes me laugh, right? Buy recommendation, I love it. Look, average target makes me laugh. 15 giving it a strong buy, 4 giving it a buy, 14 giving it a hold. I wish I was still in the industry and I was an analyst at one of these big institutions, because I swear you would see a 1 right here at Strong Sell. I would be the Lone Ranger when it came to analyzing Spotify technology here. There is no way I would buy this stock at this current level. You have a better shot at seeing Jesus, in my opinion. We're talking about a $30 billion company that loses more the more they make. They're trading, 2.5 times last year's revenue. But again, no matter how much money they make, they're not actually making money. I mean, I really see no reason as to why this stock should be higher. And this is why I laugh, right? When we used to look at stocks like GT, Goodyear Tire, and they would bring in like $17-18 billion for the year, but you're telling me the market cap of the whole company is like $3.5 billion, right? And that's a joke. That's what I mean. It should be companies like GT, Goodyear Tire, that everyone piles into on Wall Street Bets and tries to rally 200-300% and bring to the moon. This company, in my opinion, does not deserve anyone's attention. Because again, I can appreciate the fact that revenue is growing, and it is growing drastically. However, the more the more they're bringing in, the more they're losing. I have never seen anything like this before. And again, companies like this should not be rewarded; they should be punished. So that's why they could bring it up and again have this fake BS rally throughout 23 and try to have it as like a quote unquote tech staple stock, in the index. But again, at the end of the day, the company kind of sucks. And it should definitely be lower instead of higher. And again, you can see before the BS rally, look, the stock was down. It was chilling at like $70 for like a month or two. That, in my opinion, is really where the stock should be. It should be 50% lower, and that would bring the market cap down to about 15 billion. And then we can say, all right, they made 12-13 billion for the year. They're worth like 15 billion. I guess it would be more realistic. But even if we back up, you can see you had like this big rally come in again post-COVID, of course, just like a lot of other tech names, because when you give 18 and 20-year-olds a free 15-20 grand, they're going to invest in the market, and what are they going to do? They're just going to buy the stocks that they know. They don't know how to do fundamental or technical analysis. They're not doing any due diligence. They just stepped in. They started buying Spotify and Shopify and Tesla and all these random BS EV stocks and whatnot. Look, and mind you, this whole time, this company is like really reporting some crappy numbers here. You can see big misses and big beats here, right? Then we go on a run, look, where the company beat earnings on the top and bottom line 5 quarters in a row, but was down the whole time. Why? Well, it's because they took the stock from 100 to 400 for no reason. And this is what happens. And now, as you see, basically from these highs here in early 21, the stock has basically been in a downtrend, minus this last BS rally, of course, throughout 2023. But in my opinion, even connecting here on the trend line, let's get a trend line out here. What's the high? 387.44. Yeah, it's close enough, 64. And how about if we just draw across here? Right? Still not enough. I don't like to extend it all the way to the right screen. I know some people may say that, but I just like to drag it like that. But man, this stock should be here, bro. Seriously. 50% drop, bring it right back down into the 70s where it was before the BS rally, and then we can reanalyze the situation. Because again, I am very impressed with the revenue. The problem is everything else kind of sucks. So the fact that the stock is even staying up blows my mind. Revenue estimated to go up. Look, as soon as they broke above 3 billion, minus that quarter there. But as soon as estimates got up to like 3.3, 3.4, all of a sudden the company started missing. And you can see 3.5, 3.88, 3.81, 3.96. I don't know who's listening to all this music through Spotify, but the company definitely knows what they're doing, whether it comes down to just their marketing team, if that's what's really driving it along. But look at the growth here that they're expecting for the company, going up to almost $14 billion for this year, and then up to 16, 18, 20 and a half. Listen, that's all phenomenal. But just remember, if a company like this could trade 2.5 times annual revenue when they're losing money like crazy, then just remember, we should go back to a company like Goodyear Tire, and that stock should be up, 500 to 700% from where it currently is trading right now. And I am being conservative. Looking here as we see, okay, 2024, they will be EPS positive. Okay, so it's only going to take $16.25 billion for the company to make 50 cents a share. And people call me crazy. Imagine that. So, again, revenue growth, listen, that's phenomenal. However, they're pumping up a stock for no reason. Again, I will keep saying it. So that's why even if we fast forward here to 2026, $20.5 billion, you're still trading 1.5 times revenue from the current level here. So that's why I'm saying, when they bring these stocks up for no reason like that throughout earnings misses, this company, SPOT, this stock is definitely, I can't say definitely, but in my opinion, I have very high conviction that this stock is going to stay level or drop down. It should not be going up for any reason. Any reason. And remember, too, if they want to, right, if you compare a company like this to a company like Goodyear Tire, people will then say, oh, well, the net income's been kind of hit and miss, and, sometimes they're positive, sometimes they're negative. This company's EPS has been falling off a cliff. So now if you're telling me something like Goodyear Tire could trade 1/7 of annual revenue and it would be justified, well, then guess what? This stock should be like $30, right? So that's what I mean. You can't have your cake and eat it too. You can't make rules for one company or one sector and not have it and not think it applies to another company or another sector. That's just how it works. But let's look at some of these numbers real quick. We'll switch over to annual. We'll look at some annual growth here. Price to sales has come down to 2.3, but if it was significantly higher, not really a big indicator. The company is trading 675 times cash flow. That's pretty high. And of course, trading 13.25 times book value. Even 6 times book, in my opinion, is too high for this company. This is the first time I've actually seen an overinflated stock have an enterprise value less than its current market cap, right? Because if they're blowing a company and overhyping it up, you would think the enterprise value would be higher than the current market cap. But as you see here, return on assets has fallen off a cliff. This is current, okay. But, return on assets bouncing around was almost positive, dropped back down negative. Return on equity was almost positive, dropped down drastically negative, and same on return on invested capital, less than -1%, back to -10%. Gross margin, again, got up to 25 and even 26. This was a decent run here for the gross margin, and then, of course, it dropped down. Now, remember, a situation like PayPal, they took the stock from like 77 down to like 52 or whatever it was and had the stock hit new lows because the operating margin came in 0.6% below estimates. I will never forget those fundamentals. They were estimating 22% on the operating margin for the quarter. The company reported 21.4% on the operating margin. They beat on EPS and revenue, which they consistently do. And they took PayPal from the 70s down to new lows in the 50s, and everyone and their brother was very pissed and didn't understand what's going on. And, of course, I don't understand that either because, again, this operating margin went from 1 to -5.5. So that's what I mean. This stock should have fallen off a freaking cliff. And instead, they're like keeping it up and keeping it stable, and it's just laughable, man. EBITDA, once again, earnings before interest, taxes, depreciation, amortization, was up to over 2.33% and then dropped to minus 4%, now sitting at minus 3.5%. None of these numbers look attractive. The net margin percentage was climbing up, almost got positive for the year, and then of course reversed, and then almost got positive, and then reversed, and now it's currently sitting at even lower. But really, again, we can try to find positives here. Oh, we had some growth the last couple of years here in the asset turnover. But yeah, look, you go all the way back here, it was 195. Now you're bringing it up, it's at 1.5, 1.6. That should be nothing to write home about. You should be upset. You should be upset at that situation, right? It was significantly better, but now it's worse. The gross profit has been increasing for the most part over the years. Again, total revenue minus cost of goods sold gives us gross profit. Operating expenses have exploded and are now exceeding gross profit. Gross profit minus operating expenses gives us operating income, and now we can see this is the lowest operating income going all the way back to 2016. But remember, they brought the stock up, not down. Sometimes you just have to laugh. We're looking at assets outweighing liabilities. Assets minus liabilities gives us total equity. The equity only $2.5 billion, yet somehow the company's worth $30 billion. Company holding a couple of billion in debt. And as we see here, book value per share $13.26. Stock trading $158. Book value 13. Right? So look, back in 2020, $18. Even going all the way back in 2018, your book value was 13.25. And now, 4 years later, you're still worth 13.25. Like, I don't know. Maybe it's just me. Maybe it's me. I don't know. But, yep, looks like cash flow fell off a cliff. We went from having, a couple of $100 million in our pockets. Now we only got 20, 30 mil. I don't know, man. Really, any way I look at it, it doesn't look too good to me. Now, granted, I can see the explosion here in cash that people are talking about. But again, the company is bringing in tens of billions of dollars and isn't making any money. So that's why I don't even know how much weight I would put on any of these potential positives that you can find here. But again, that's just me, the way I look at it. And also the way, the way it plateaued here, actually dropped in revenue from quarter to quarter just to get back to a little higher than where it was, yet the company misses 3 quarters in a row and the stock got rewarded. So again, I'm really just not seeing it. And again, I'm very surprised that I'm even looking at numbers growing here. I didn't know people enjoyed Spotify so much, but again, what I enjoy are looking at these graphs and, more importantly, analyzing these figures and a lot of these fundamental metrics here and a lot of this economic data. Because again, at the end of the day, I really don't see anything aside from the growth in revenue, which of course is really nice. I'm just not seeing how this company could stay at this level and again have a rally like this through 3 earnings misses. I mean, in my eyes, it is inevitably going to go down, and I do feel that I would not be a buyer of this company. I'm not sure when it will be a buy. Right, if we just draw a trend line down like that, as you can see, double rejection there on the trend line, and it recently rejected, right? It just pulled back and sold off and got below the moving average there, and then you can see we had the pop today, only because markets were out of control, so it had to pop today. But in my opinion, I think it's going to reject. It's going to break this 151.11 fib, and it's slowly going to pull back. I think it's going to make lower lows. And that's why I feel, yeah, listen, it may take a couple of months from now because, again, you're dealing with a BS overinflated stock. So they're going to take their time probably bringing it down. But I have about 90, 95% conviction right now that this stock should definitely sell off in the next few months here to sub 120 here, and of course should fill that gap back down to 104. Again, all of this happened on 3 earnings misses and wider than expected losses. So I don't know who's buying this stock, but they must like the color red. I don't know. And even looking at stock charts here, I'm really not seeing anything. Yeah, the Bollinger Bands are tightening up here. But again, in my opinion, I think it goes down. I think it starts breaking and retesting these moving averages and dropping down into the 140s and the 130s. RSI sitting here at 53 3/4, not showing us much. Just look at how flat it's been. That's what I mean. It's like it's supposed to go lower, but I feel like they're keeping it up. Like there's people behind the curtains buying shares of this to try to like stop the bleeding and the hemorrhaging that would take place if they stopped supporting the stock. Yeah, it would probably plummet to sub 100 immediately. Just my opinion, of course. Look at how flat the MACD is. That's what I mean. It's like they're trying to keep it, but it really should crap. It really should crap down. RSI sitting at 57 on the weekly. Yeah, unfortunately, this is what I mean. Some stocks get pumped up like this, and just look at that rally. Again, going from mid-70s or where it was up to almost $180 a share on nothing but misses for the year. This is why a situation like this, if I had big liquidity and I can really buy a lot of time, I would just consistently just add to my position and just keep rolling out puts on this stock, because in my eyes, I believe that it's definitely going to start chunking down sometime soon. But that's just my opinion. If you know something that I don't, of course, let me know down in the comments section. I always keep an open mind. I always like to look at all different angles, So maybe there's something I didn't touch on here with Spotify, because again, I give them a lot of credit. We're seeing phenomenal growth in revenue, and I can appreciate the fact that people may find it attractive because of that. But again, looking at the numbers, I'm really not seeing a big reason as to why this stock should be up. It should go all the way back to where it was before it missed and caught 150% rally. But, that's just me. That's just the way I look at it. And I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And, of course, subscribe to the channel. That is our handshake agreement. I'll look at companies like Spotify. I'll do updates on stocks we looked at in the past. And I'll throw out any potential short-term trade ideas I may have in the Discord. Discord link in the description of every video. And, of course, I'll do all of that for you guys. All I ask, just do me one favor. Push the subscribe button. That is how you help me help you. But more importantly, like I always say, I understand that markets are rocky and they're volatile and they've been very uncertain. So I want to wish all of you success. I hope everyone makes a couple of bucks. Thanks for stopping by. I'll catch you in the next one.